Yeah, the whole time.
Welcome, everyone. Happy to be here. Actually, very excited about this panel for multiple reasons. One, I am probably the most crypto light person in this room, and I'll explain that in a second. But I know that we share a lot of the same challenges when it comes to mitigating risk and managing risk. Me on the Web3 and NFT side of things, you guys on the traditional finance and decentralized finance side of things. So want to talk to you guys about that a little bit. My name is Ralph Quintero. I am the founder of the Daily Ralpha. That is a publication that goes out every morning. It's a short read, 5-minute read that gives you a pulse of what's going on in the NFT and Web3 marketplace. Beyond that, I am the Chief GM Officer at JPEG Morgan, big NFT collective, and I am also one of the co-founders at Crypto League, a startup in Miami that I'm very excited about. I'd like to introduce Anthony Rousseau and John Devine to join me today. Gents?
Yeah, thanks, Ralph. And thanks, everybody, for being here. So before I tell you a little bit about myself, I want to give a shout-out to Messari and the whole team here who's put on Mainnet. This has been a very well-attended event, and anybody on the live stream, I certainly would recommend you guys come on down to the show next year. It's well-attended, a lot of sharp people here, and a lot to learn. But the background on me, I'm a former commodities trader. I was an algorithmic market maker in precious metals, interest rate swaps, and energy crack spreads. That was my prior life to crypto. I did a little stint doing environmental products as well before I was trading at a crypto hedge fund. Now I'm currently with BlockFills, and we make markets on spot, options, perpetuals, structured products. We do lending and borrowing. We also do minor financing for hardware equipment purchases, specifically for Bitcoin. That's my story.
Thank you, John.
Thank you.
Anthony?
Awesome. Thank you very much. I am Anthony Russo with TradeStation. You see him over there, says James Putra. That is not me. I am Anthony Russo. I am the stand-in. I'm the good-looking stand-in.
Better looking.
If you could see his picture right here, you definitely would know it. But anyways, with TradeStation, my background is I've been in the capital markets business for over 17 years. Started on the buy side, managing risk on trading desks for FX and equities. Migrated into technology and product roles throughout my career. Was on the sell side of the business, working for some large banks, working in primarily principal FX market making. Did a ton of innovation in some of these big banks around crypto and around blockchain technology and trying to be the bridge of TradFi into crypto. And then recently came back to TradeStation. I was at my second stint at TradeStation now, running their brokerage solutions. Really, TradeStation, if you aren't familiar with them, we're an online broker. We cater to active traders, providing investors with access to markets, trading tools, and education. And yeah, excited to be here today. Thank you for Messari, and thank you guys for all coming to listen and hear about some tips of trading and tools and managing risk. And I think just talking about managing risk, a lot of us come to this space for different reasons. And I think it's really important to understand that the underlying of what we're dealing with here has to do with risk. We got a lot to learn from Ralph on the venture side. A lot of what you're seeing in this space is really venture plays. And I think a lot of us come to this space not really understanding that. And I think today, hopefully, we can talk a little bit about what's happening in the macro side of things, and then also some more strategic tips and tools of how to manage your maybe hodl position that you have.
So just out of curiosity, how many people are active in crypto day to day? NFT holders active in Web3?
Yep.
Awesome.
Yeah.
Great mix. So you'll appreciate how excited I got when I first got the panel description. And I don't know how many of you guys actually read the panel description, but they were talking about Bart Simpson chart patterns. And I was like, man, we're going to talk about NFTs. And then I realized that we weren't talking about NFTs, although there's some interesting correlations that we can draw with regards to how we manage risk. So there's no doubt that we are deep in a crypto winter. We've been talking about it for some time. Is this similar to the other crypto winters we've seen, or if not, how is it different in your perspective, John?
Yeah, I think we're certainly in a crypto winter, and I think the big difference from the last cycle, let's call that 2018, is the institutionalization of this marketplace. So, just 4 years ago in that last cycle, this market really was not institutional. What I mean by that, there was not the large hedge fund participation in the marketplace. There was certainly a lot less participation from proprietary traders on the liquidity provision side, and with that being said, there was certainly a lot less focus on how to manage risk in that prior cycle. So I think where we've come to date is we've seen a maturation of this market, and I think we will continue to do so. And some of the strategies we're going to talk about today on managing risk are going to be staples, not only for hedge funds and proprietary traders or just holders of the asset, but also for the producers of these assets, the miners and the validators on proof-of-stake networks and the miners on proof-of-work networks. That's the main difference, I would say, from the prior cycle.
How about you, Anthony?
Yeah, I would definitely agree with you, John. I think a lot of what we have seen today is definitely institutionalization of this marketplace. A lot of it can be correlated to if you look at just TradFi right now, definitely going through its own bear market times due to many macro elements that are taking place that are affecting it. And there's really, in some of these huge macro changes that take place, huge shifts, there is sometimes no place to hide, so all assets can be impacted. And when you look back at previous crypto cycles, and I'm 2016 is really where my education curve really took off. 2017 is really dove deep, and personally invested, participated in mining, and just did a lot of education, invested in education, also capital as well. But I think, when you look at 2017, 2018, there's definitely some similarities, and I'll give you a couple to think about. From a macro perspective, in 2018, when we were in a bear market, we were in a beginning of a new interest rate rising environment. Okay, and that was the last time we were raising interest rates. So what does that actually mean? That means that we were actually constraining capital, right? We were reducing liquidity, okay? And what happens is that capital gets taken out of the system and there's less risk capital that can be invested. And when you start to look at what crypto actually is, crypto is out on the risk curve. If you want to have something a little bit more secure, you're going to think about maybe a treasury, right? Even though right now all assets are pretty much correlated because bonds are going down, stocks are going down, crypto is going down. Essentially, when you look at crypto and from a traditional finance perspective, you're looking at it from a out on the risk curve type of investment. So therefore, you're going to see much greater beta opportunities with a crypto asset. So back in 2018, if you really think about it, that's the last time we had a really crypto bear market. So part of that was also constrained assets. Now there's these four-year cycles that we've been living through. Everybody thought that 4-year cycle was over in this previous bull market. Everybody said, that's it, this is it, we're just gonna continue to go up forever. That didn't happen. But yeah, I think most of the challenges about understanding how to manage risk are really the fact that not knowing or understanding what's happening on a larger scale can really impact your decisions. Now, some of us come to this space and just say, well, I'm just a hodler for life and I'm just buying and DCAing and that's fine. You can do that. But it's still important probably for you to educate yourself and know why things are happening and what really are the things that we need to happen for capital to come back into this space for that next bull market to happen, right? And what factors are impacting that?
So you've both talked about kind of macro factors. We've seen quantitative tightening. We've seen increase in interest rates. How's that affecting the crypto markets this time around?
Yeah, I mean, I'll take that one first. I think you look at the policy action that's happening right now. It's some of the most aggressive policy action the Fed's taken in decades. And I think that if you look at the reasoning for it is that we had kind of the opposite effect previously where we had zero interest rate environment for years, money for free, and essentially quantitative easing, which is really putting money, creating a system of liquidity which risk assets live off of. We've built a system in that manner And if you were to actually put the Fed's balance sheet as a denominator to like the S&P since 2009, you're going to notice that the S&P was pretty much flat for the past 12, 13 years. There are very few assets, I would say Bitcoin is one of them, that actually outpaced the Fed's balance sheet, right? So right now the Fed's balance sheet's around 9 trillion. They're starting to do quantitative tightening. What does that actually mean? That means they're taking liquidity out of the system. They're raising interest rates to crush demand. Those things are going to impact this market. It's going to impact our investing. It's going to impact traditional markets. And it's going to not be forever, but it's something to be aware of. So when people are trying to make their decisions on what they're doing in this space, they can understand their time frames and understand how to manage their risk and how to size their positions and whatnot.
Yeah, I think that's very well said. Just to chime in on that point a little bit, relative to the last cycle, especially is now we're all focused on the Fed, and in this last cycle, I think that was not a glaringly obvious talking point amongst crypto communities. But that's just showing you how fast this marketplace has really evolved and become institutionalized. And now we need to pay attention to this stuff. And these market-moving events, these CPI prints and these FOMC meetings, crypto communities are talking about them now, and they're moving the market. And we are trading crypto as a beta asset relative to traditional assets.
Is that one of the reasons you think that there's much more of a correlation between crypto markets and traditional markets this time around, or now, where we're seeing much more of both of those markets moving kind of in unison?
Yeah, I would certainly say so. You have a fund manager who's taken a large position in crypto, let's say Bitcoin, Ethereum, or any of these tail assets. They're used to trading a certain way and used to digesting information a certain way, and that's going to bleed over into how they manage their crypto portfolio.
Yeah, I 100% agree, and I think you could even see it to the point where, because of the type of beta asset this is, you could see that there's possibility of indication of directional turns that take place, leading the traditional markets with beta assets like Bitcoin or Ethereum. There's certain narratives that you would think that would, overcome some of this, macro pressure, I would say. Like, for instance, the Eth Merge, for instance, there was a great rally in ETH, bounce off of a bottom, and people, a lot of people were believing that this was it, that we were going to just continue to go up forever, and that things don't go up forever. The reality has to be set back in place for these assets. And true value will always be told by price. And that's the thing about crypto, I think, that people don't realize, is that we're actually dealing with some sort of venture type investment, effectively. And it's very early stage. And some of these assets are considered network effects. So over very long periods of time, you're going to have great adoption opportunity, and growth will come from that. But in between that long spectrum, there are ups and downs, and they can be very volatile. And it's like any technology coming to the space. There's this technology curve, an adoption curve that's happening, and it's important that we as participants, no matter what level we stand on, whether we're managing risk on a daily basis or you're managing a long-term position, it's important to understand these things so you can make the right decisions at the right time for yourself.
I love the fact that you brought in the VC angle, right? Because looking at it from my perspective on the NFT side, particularly now where we're seeing the kind of market that we're seeing, the approach that a lot of active NFT traders and investors are taking are much more aligned with kind of the VC model, where you're deploying a lot of investments across a broader spectrum and hoping that one of those teams that you ultimately invest in are going to be the ones that are going to be the next Bored Ape or the next Doodles or Azuki projects or one of those. So it's a great segue too to just start talking now about just some of these tips and strategies and tricks that we could all kind of employ to help start managing some of this risk based on all the things that we're talking about. So, like, what are some of your favorites, John?
Yeah, certainly. So let's zoom out a little bit. We're about 13 years from the inception of Bitcoin, so we need to realize how early we really are, right? And if we think about the progression of this marketplace and how it's been built out, we first had to start with spot markets, and a lot of this stuff traded peer-to-peer to start, right? And then we saw the advent of some centralized exchanges come into play. From spot, then we saw the advent of perpetual swaps. And the progression there is then there became a lending and borrowing market. And now if you can borrow dollars against Bitcoin as collateral or Ethereum as collateral, well then now there's actually a way to develop a forward curve for futures markets. So now, spot, perpetuals, lend, borrow, futures. Once futures came into play, now there's ability to have an options market. And this is where, we can go back to our prior talk, the difference between the last cycle. In 2018, there was no liquid options market. So if you're a professional capital manager, you're used to managing risk with derivatives such as futures and options, there was no lever to pull in 2018. Now in 2022, we do see a liquid options market for these main assets. So, just let's think about some basic strategies. There's something called a covered call. Now, a call option, if you are a buyer of a call option, you are buying the right to own that asset at a strike price at a preset expiration date. So let's say Bitcoin's trading at 20,000. You can buy call options for Bitcoin 30,000 that expire on October 28th, 2022, and that gives you the right to own Bitcoin at 30,000. It's leverage, okay? But if I'm a holder of Bitcoin, I can sell that call option. I can sell someone the right to own my Bitcoin at 30,000 in the next 36 days. That expires on October 28th, okay? That right there gives me an angle into yield. So I'm a hodler of Bitcoin, or I'm a miner of Bitcoin, or whatever. I'm a hedge fund manager who holds Bitcoin. I can do what I say is an optimized yield strategy where I sell covered calls every single month against my Bitcoin holdings. This was not possible in the last bear cycle. So now that we can do a yield strategy like a covered call, there's another type of an option called a put option. A put option is the right to sell an asset at a predetermined price. So let's say Bitcoin is trading at 20K. I can buy a put option at, let's say, Bitcoin 15,000. That gives me the right to sell my Bitcoin at 15,000. So I'm a holder of Bitcoin. Bitcoin's trading at 20,000. I sell a 30,000 strike call option. I annualize a yield from that. I can either put it in my pocket for yield, or I can take that yield and buy protection at zero cost. That's the type of strategy that's coming into play right now, and it's really helping professional investors manage risk on crypto.
Yeah, that is an amazing difference between 2017, 2018, and now. Are these tools that professional investors didn't ever have access to. So previously you'd be sitting in a long spot position and you'd only be able to sell the position. You'd never really be able to continue to hodl and protect your downside, which was really, and I remember in 2018 when everybody was talking about, oh, institutions are coming, oh, they're here, they're coming. And the reasons were that infrastructure was not really in place, right? And it's still being built. It's still early days. Real institutions are still not here. The real large aggregators of capital and assets are still not here yet. They're starting to come. They're the ones that are going to start building larger infrastructure components that they want to utilize in order to access these markets. And I think that's where, what John just spoke to you about is some ideas of how to manage your risk with the existing tools, and that will just continue to proliferate. At TradeStation, we provide you access to markets. In the U.S., the regulated products is what we focus on, and as far as like futures and derivative products, CME, CME futures, is really what we offer, and we provide tools for you to actually manage this risk. But there are all a plethora of opportunities if you guys are international and can access international products. They're growing at a much faster pace than in the U.S., which is exciting. Which is exciting to see, and this is why, from my perspective, personally, it's exciting to see because this is a global market. And it's not just a U.S.-centric market, and it provides for such greater innovation opportunities for us to be able to participate, help build, and then also help manage risk along the way.
Anthony, you mentioned we're early and that the big money hasn't moved in yet. What are some of the hurdles to that big money coming in? Like you mentioned that we're just starting to see it start kind of coming in. What's been preventing them from coming in, and kind of what's changing? What's the changing tide that's allowing them to start coming into the space?
Yeah, and I'm not going to say anything new that anybody already hasn't heard. And I think there's a panel going on with one of these, I think the head of CFTC right now on the main stage. But essentially, regulation, I think, for these larger institutions, I used to work at a State Street Bank, and that was one of the largest hurdles that we had. I was part of the innovation team over there trying to educate and really try to get these larger institutions to really understand what this actually is and what the opportunities are. But a lot of it has to do around regulation and trying to get an understanding of what this is, because a lot of these larger institutions, aggregators of capital, have built up these huge opportunities and risk profiles, right? And then I think that this is a risk-reward game for them. And for them, it's far greater risk than reward to enter this market right now. And until they can have that clarity, and until they can have these types of products and these tools, they're going to be really slow. And if they don't have them, they're going to help build them. And that's really where they are. And so therefore, you're still looking at years away from real massive adoption, where it becomes, we don't even talk about, guys like us on a panel won't talk about this anymore, because there'll be more exciting things about the NFTs and the front end of this. We're just kind of the back end engine, essentially, from a risk management perspective.
Yeah, I'll second that. I really want to focus on liquidity when we talk about this conversation, on what's, what needs to happen to bring some of these massive capital allocators into the market. We've discussed that these asset managers need to be able to manage risk. We've talked about the advent of how this market has developed from all the way from spot to options. Well, now that we are here in the options market, is there enough liquidity for them to manage risk? Right now, there's still not quite enough liquidity for some of these larger institutions you're talking about to really get on options positions properly. They're still just too big, but that liquidity continues to develop every day, and I think that's going to be a catalyst for some of these firms we're speaking about to finally come into crypto, because when they do, they're not just going to hold this stuff. They're going to hold this stuff, and they're going to manage the risk doing something. I'm talking, selling a covered call. They're going to be doing that. They're going to be selling calls and buying puts at zero cost. So they're not just going to be holding an asset, letting it float free. They're going to be managing the risk around that position. And they need the liquidity in these options markets and futures markets to get those trades on.
So a couple weeks ago, we had one of the most exciting events to happen to the crypto space. We had the Eth Merge. There were parties all over the world. People stayed up. I would argue that it's probably the most important event that we've seen in a long time. Now that that's behind us, how did that affect the crypto market, the spot markets, derivatives, all of that stuff from your perspective?
Yeah, so this is where I'd like to get a little bit on some market internals that I think are important for us to know about. So there's something called a put-call skew. And in simple terms, this is asking how much more expensive is protection relative to upside speculation, or how much more expensive are put options relative to call options. When we saw the merge, as we were going into the merge, we saw a tremendous amount of demand for call options on Ethereum, and this moved the skew, and so you could really keep your eye on the options market and get a gauge, a market sentiment as to where this where the market is thinking this thing is going. Now, as a risk manager, I'm looking for these events. I'm looking for people to bid up call options so that I can manage my risk by selling those call options. I think this market internal, a put call skew. Everyone needs to know about this stuff, and everyone needs to be looking at this stuff. That was the biggest thing I saw into the merge, was there was a demand for upside exposure on the front end of the curve, although we did see demand for protection in October and November, after the merge was expected to happen, just in case there was a problem with the tech integration. People wanted protection, they wanted speculations in September.
Yeah, and I think just to add to that, I think, John, you probably could definitely dive into this a little bit deeper, but for us, validator, contributors and holders and those who are staking ETH out there, what are your thoughts on how we can best manage, our risk, considering that you can't really sell out your ETH position, But there are tools that we have now at our exposure that we can actually utilize. What are your thoughts on that for those validators and those who are staking in ETH right now? That's pretty much locked up till Shanghai, right? And so it could be a period of time of unknowingness, but there's going to be volatility throughout. So there's going to be wanting to get liquid in some scenarios, and there's going to also be wanting to some protection in some scenarios. Maybe dive into that. That'd probably be pretty helpful.
Certainly, and I'll loop this in as well with proof of work mining block rewards as well. So just to step back a touch, when we saw this market, kind of cut through some pretty big support levels at the beginning of the summer, there were headlines that there were some publicly traded miners and Bitcoin specifically selling coin to make sure they had enough capital to manage their operation. What this tells me is that the mining community and now the validating community for proof of stake, they're still not grasping the concept of protecting downside exposure. They're still letting this asset free float and expecting it to cooperate in the manner we want, which is price appreciation. But now that we've had this move through some key support levels, and we've seen the public statements from miners that they had to capitulate and sell spot to cover OpEx, I think now the conversation is ripe for hedging forward block rewards. So let that be if you're a miner in Bitcoin or if you're a proof of stake validator in Ethereum, you're now going to be able to see and forecast what block reward am I going to be getting from my validation or from my proof of work mining operation. You're going to be able to calculate how much ether. Let's talk proof of stake ether. How much ether am I going to generate this month from my proof of stake validation? Okay, so now once we can understand that delivery of ether from validation on the protocol, now it's time to talk about the strategies I just told you about, covered calls. So if I'm going to validate on the ether protocol and receive rewards for that, I should be selling covered calls against that forward production. That at least gives me a yield. If this market keeps going lower, I can at least get a more enhanced yield on my proof of stake. And if to go further, instead of putting that money in my pocket as a yield, I can buy put options, which means I'm now able to manage the risk around forward production of Ethereum from my proof of stake validating node. And I think that's where this next conversation is. Certainly the hedge fund managers and proprietary traders in the market know about this stuff, but it's time to educate the tech side of this marketplace, the validators and the miners, on how they can protect risk and manage forward production. That's where I think this goes.
Yeah, no, I 100% agree, and looking at just like you mentioned, Ralph, ETH being probably the #1 story in crypto this year, narrative around a major change in a protocol that is highly utilized across the space. I think looking back at it, at the time when early September coming into it, I think there was probably a lot of surprise that second week when we were about to go live, and all of a sudden price started dropping off a cliff. And I think a tip for people to understand is that I don't think a lot of that had to, and this is my personal opinion, had to do necessarily with the merge itself. And a lot of people say, people were buying the, buy the news, sell the event type scenario. There's a little bit of that maybe that had play into it. But if you really think about what was happening on the macro scale, this is why I think the tools and tips of what to use inside the space to manage your risk, but also education on understanding what's happening around on a macro perspective. That was right around the time that CPI print was actually announced here in the U.S., which was a highly sought out number, which was expected to be much lower than it was. And that basically told investors that the Fed was not going to be pivoting and not going to be reducing liquidity and not going to be pivoting on interest rates anytime soon. And they came out and made the statement this week and said that. And I think that's where you're seeing that sell-off that took place. But you could see that ETH was leading that charge. And it did take a bigger hit than most other assets because of, I think, the actual, leverage that was actually in that asset. And that's why you're seeing volatility that takes place. And that's why you got to be cautious and careful when you're in these positions.
How much of an influence do you think all of these NFT speculators, I'm throwing myself in that bucket, right? Because prior to all of this action that we've been seeing in the NFT space, it was pretty much a crypto game, and now all of a sudden you've got people that may not be as educated on the crypto markets in the traditional sense, like you guys have been describing. How much of an impact do you think that has actually had into what we're seeing in the market, or do you feel that it's kind of still a non-issue right now?
So, NFTs, if you talk about crypto, you look at crypto, you look at the spectrum, you probably think that Bitcoin's probably the safest asset, and then you go out on the risk curve, you're like, you look at these NFTs, and then you talk about NFT risk, you're like, well, Bored Apes is the safest because I think it's holding value, and then you start to go out way on the risk curve of an NFT. So I would look at personally how I would categorize NFTs in a risk spectrum is it's the highest beta asset, but it's a lot different asset than I think what we're talking about when it comes to the markets of crypto, because the markets of crypto have liquidity, have pricing each and every day, deep markets, infrastructure that's in place. Even though we said it's nascent and it's still building, I would say that right now the infrastructure for NFTs is far more nascent. Yes. There's extraordinarily illiquidity across the entire space, and you're really susceptible to the participants that are in each of these NFT groups that are trying to build value outside of just the NFT itself. That's where the true venture play is, and I think that's where like expertise in your education and background it comes in important. So anybody coming into the space would have to start to really think about it from a different perspective, right? For
sure. I mean, we've all heard people say that they're into NFTs because of the art or because of the community, and I mean, I may agree with that to a certain extent, but we're so early in the game that I call BS on that. I still think that more than 85% of the people in this space right now, as far as the NFT side, all speculators, right? We all are looking for that next high of the next Bored Ape. And the likelihood of that happening again are about as great as being struck by lightning, right? Yeah. Like, I think we'll see one or two pop up, but I don't think that that's going to be the norm. Right. I do think that during this time, and you and I were talking about it yesterday, and I want to touch base on it a little bit, is that there are certain plays as part of your risk management strategies, if you wanted to move into the NFT side of things, that you can start looking at. So we've got blue chips, just like, in the traditional sense. You mentioned Bored Apes. There's still a lot of great opportunities in some of those projects. Like, yesterday, the biggest NFT sale of the day was a 100 ETH Bored Ape sale. So even if you're holding an ape or you're holding an Azuki or a Doodle, like there is still some liquidity you can get. It's going to be floor price. You may not get the value for the rarity that you have, but there is some liquidity. Now, when you start, veering away from those projects, not too much liquidity, right? Like the likelihood that you're going to sit on that is high. But you and I were talking about utility built into these projects, and we were talking about carbon offsets and some of the other exciting things that we can start looking at as hedging options. So NFTs, especially for the Ethereum ecosystem, they really drove organic protocol interaction from users, right? And that's a key metric that if you're a fundamental analyst looking at these different blockchain protocols, you're looking at that. How much organic activity is going across this chain, and that's, when we had our big bull run, there was a ton of organic activity going across the Ethereum protocol for NFTs. And that metric is going to stick off the chain, stick off the chart, for any fundamental analyst looking at Ethereum, for example, or any of these other, Tezos. There's a couple others that are big in the space. So I think that's what NFTs have done for Ether and some of these other chains, is they brought real use case. And now we talk about, aside from art, what else is our NFTs going to accomplish? And I think a big market there, I'm seeing it all over the place, is carbon offsets. I think now we've tokenized carbon offsets. This is a headline topic, mitigating carbon emissions. This is a big topic that will be with us for the next decade, even further, obviously. So now we're saying the blockchain can help us accomplish the goal of facilitating trading in carbon offsets, which in turn mitigates carbon emissions around the world and props up renewable energy technology projects. This is a big use case. And I hope to see the industry really push this. Market access to this stuff is very difficult. You want to buy a carbon offset in the physical world, it's all over the counter. You got to find a broker. It's not easy to buy a carbon offset. What NFTs have done is opened up market access to carbon offset exposure.
which in turn drives more capital into the marketplace, which drives up the price of carbon offsets, which then in turn helps us, accomplish our goals of, mitigating carbon emissions. That's a big one. The other thing that pumps me up about NFTs is royalties. I think that's understated in just how big
100%.
blockchain is going to change the world in terms of how artists are paid and how royalties are distributed to to the original creator of that asset or to whoever's sold it on forward. So those are the two things that really stick out to me for NFTs, and the more organic protocol interaction from NFTs, the more use cases, the more valuable these networks become.
I agree wholeheartedly with you on that. I think the utility plays are going to be huge. Yeah. I'm very bullish on music NFTs. I think that's the next area that's ripe for disruption. One that a lot of people don't talk about, and it's kind of a sore subject at some conferences, but I bring up anyways, is the porn industry, right? Like, they are notably late to this space, but I think as they start working through, and I know that there's several projects already tackling that, we're going to see some pretty interesting innovations in this space. I want to be mindful of the time. We've got about 4 minutes left, and I know that we've talked a lot about different strategies, about different things. I want to be able to open it up in case anybody has any questions. If you just want to raise your hand, they'll bring a mic over. We're happy to answer questions, whether it's about strategies, NFTs, or anything else. Sir? Sure. Actually, let me grab my headphones so I can hear you.
Hi. My question is the following. We've seen, obviously, a big correction in winter market for about a year now, but on the other end, the fundamentals have been pretty solid. Do you see at some point a decoupling, meaning the economy will probably still struggle for a while with this macroeconomic situation? Do you see this, basically, the end of this bear market in crypto ending with a light on the macro, or possibly an earlier turnaround of the crypto compared to the macro? And if you do, about when or how sooner then the macro will basically turn around?
Did you get that?
Yeah, I did.
Okay.
Yeah, I can take that. That's like the $1 million question, and I don't have a crystal ball, and I don't have the exact answer. I definitely wouldn't put myself out there to say when this bear market's going to end or when it will turn. What I would tell you, though, is that the factors that I pay attention to are really, right now, the global economy. There's three things I look at that are simple that I think anybody can look at. Is the dollar. That's number one. 70% of trade, or give or take, is done in the dollar, so dollar dominance. The other two pieces have to do with the Fed. The Fed drives policy, and interest rates going up and quantitative tightening sucks liquidity out of the market. That right there, those three factors directly impact this market just like every other market. You're not going to hide from that. So I pay attention to that because when we look back at charts, you can look at the history of when we were in these times of quantitative tightening or quantitative easing, and you can actually see correlation of risk assets following that trend. And I think it's important to note that we're likely going to be still following that for a while. But I would say this, that I would think that the market is smarter than we are as individuals, and it will show us through price action a lot sooner than the economy will show us. The economy is going to be a laggard, and all the things they're going to talk about, we're going to get peak bearish, and everyone's going to be bearish, and peak doom, and the market will turn on us. And that will be a sign. And then you'll see likely things fall into place, and it takes time, though. I think overall we definitely have duration. That's important in bear markets. And crypto, I think we're right on target. Like, we haven't been in a bear market longer than historical times. So those are important factors to take a look at, because there are a lot of good things happening in the space. On an institutional level, institutions are building in the space, infrastructure is being put in place. There's a lot of great things happening. There's more capital, I think, that's coming into crypto. NFTs still, people investing in projects that I've ever seen in the past. So I'm really bullish in the space as a whole, but caution. Caution in using risk strategies around that is how I think about it.
John?
Yeah, I'd like to touch on that a little bit. So I want to really focus on market internals here, and this is what I talked about, that put-call skew. How much more expensive is protection relative to upside exposure? there's another metric to keep an eye on, the basis. So we have our spot crypto, what you can buy and sell Bitcoin, for example, at today. Then there's a futures market for Bitcoin. What is Bitcoin being priced at for October 28th or for the end of November, et cetera? When we have a bull market, well, in the last bull market especially, put-call skew inverted. Call options were more expensive than put options. The demand for upside exposure was more expensive than the demand for the price for protection. I'm looking at that. Right now, the demand for puts is still very strong. This market is in a downward trend. If you're long crypto, obviously a lot of us here are long crypto. We are counter trend right now. That's why I'm focusing on some risk mitigation strategies. But that's a big one to look at. Put call skew. When does that demand for upside exposure begin to become more expensive? That's a key one to look at. The basis as well. How much more expensive is forward Bitcoin? Bitcoin that is delivered in October, let's say October 28th. Right now we see that flat to spot, and really it's been backwardated, which means the forward market has been priced lower than spot. That's bearish. So those are two market internals to keep an eye on, and also the trend. As we say in trading, the trend is your friend. Right now, long crypto, your counter trend, but that's another certainly a thing to look at as well.
Do we have time for one more question? Couple of questions.
Hi, what do you guys think about the on-chain options and the use of exotic options for liquidity incentives?
Yeah.
On-chain options.
Yeah.
Exotic
That's a great. I thank you for asking that question. So this is these option vaults that have been developed, and I think Ethereum we can use as the example protocol for that. This is super interesting. Now we're talking about this is decentralized finance, where your counterparty is a protocol essentially, and you're not dealing with a market maker such as BlockFills. You're not dealing with a TradeStation. You're dealing with a protocol that's built on the Ethereum blockchain. And these option vaults, they allow you to have access. It's like a DeFi spot market where you can buy and sell these assets decentralized in a decentralized manner. Well, now we're seeing the evolution. Now there's options markets being presented to participants on chain. I think this is the evolution of blockchain and the evolution of decentralized finance. There's going to be spot, there's going to be perpetuals, there's going to be options. There's obviously been lend borrow. That was a big one for DeFi, being able to borrow against your assets from a protocol. Now these options vaults, you can sell covered calls in these options vault. They actually have the scheduled strategies where every month they're selling you a covered call. This is where blockchain shines, in my opinion, and where this whole, where finance goes into a decentralized capacity.
Oh, so we got time for one more question, gentleman with a white cap.
Thank you. So kind of, I guess, my question's alluding to a lot of the stuff you guys are talking about throughout the conference was, how are you guys looking at deploying capital? Because you talk about like frameworks like, protecting risk, selling these covered calls. If you're long crypto right now, is that your strategy through the bear market, or did you, exit to fiat some of your positions at the start? Like just kind of let's pick your brains there.
To start that? To start that conversation, the question is, how do you deploy capital right now in a bear market? So, if you're already long these assets, the strategies I talked about, the covered call, that's your play. The zero cost collar, selling a call, buying a put. But if you have cash, well, let's think about this for a sec. If I buy a put option, I'm buying the right to sell my asset at a predetermined strike. Let's say Bitcoin's 20K, I buy the October 28th 15K put. I know I can sell my Bitcoin at 15K. The seller of that option has the obligation to buy your Bitcoin at 15K. And you're paying for that as a buyer of the option. You're paying for that right to sell to the holder of that put, right? So let's think about this. If I have capital, I want to be a put seller, okay? And now I'm a seller of the 15K Bitcoin October 28th put. My obligation is I have to own Bitcoin at 15K if it settles below that strike price at expiration. And in turn, and up until expiration, I get a yield. And those yields right now, you talk about a 20 delta, 25 delta put option, those yields are north of 35%. Okay, if you want to deploy fresh capital, instead of buying spot, you sell put options.
Awesome. Well, Anthony, John, thank you so much for all the insight. I appreciate you guys joining me today on stage and sharing with everybody. To the team of Messari, thank you so much for having us. And for everybody watching out there as well, thank you for joining us. Have a great afternoon.
Thank you, everybody.
Thank you very much.
And go check out Daily Ralpha look up BlockFills and come see us at TradeStation.
Thank you.